Good afternoon. I'm Dr. Fasasi Kazim Adiola. Our topic for today is accounting equation. The next thing is, what is accounting equation? Accounting equation is a mathematical expression used to summarize financial statements. What do we mean by this? Financial statements in practice are bulky. Some financial statements has pages to up to 180 pages. It will be difficult for users of accounting information that may not have in-depth of knowledge of accounting to read page by page of the financial statement. In that case, there is need to summarize the financial statement into what a layman can understand. Due to this, we are able to come up with accounting equation. Using a mathematical equation to summarize the financial statement of an organization. What are the components of this financial statement? We have components of financial statement. Now, these components include one, statement of profit or loss. Two, statement of financial position. Three, cash flow statement. And four, statement of change in equity. These are the four components of financial statement. Now, we have statement of profit and loss, statement of financial position, cash flow statement, and statement of change in equity. Accounting equation can be used to summarize these four components into mathematical equation. That will be simple for users of accounting information to understand and to also use it for decision making. Now, before we go into details of accounting equation, there are some basic terms that a beginner in accounting should be able to understand. Let's go into these basic terminologies. Basic terminologies. I will call it basic terms. The first terminologies we are going to be looking at is capital. The question remains, what is capital? Capital is the money introduced into the business by the owner. The money introduced into the business by the owner is known as capital. The question remains this. Some people can also define capital as the amount that is used to start up a new business. But 5 years, 6 years after the business, some owners still put more money into the business. What do we call that? We can also call that additional capital. In that case, the money introduced into the business by the owners are known as capital. The next terminologies we need to know is, what's the meaning of asset? The question is this: what is an asset to the business world? Assets are resources are resources controlled by control by business entity, controlled by business entity to generate economic benefit. What do we mean by this? Assets are resources, very key term, controlled by business entity. What do we mean by control? And what are resources? Resources are things or items in your business that you can use to generate profit. The profit generated in the business is what is known as economic benefit. In that case, why control? Previous authors have defined assets as resources owned by business entity. The question mark now remains this: must you own an asset before using it to generate economic benefit? The answer to that question is no. Some assets are lease. Lease means you use it for a certain period of time to generate economic benefit and release it back to the owner. In that case, if you have leased an asset to engage into business, for instance, if you lease an asset to operate your business and the asset is not owned by you, that does not stop you from using the same asset to generate economic benefit. But some assets are also owned by the business owners, meaning it is owned by them. In that case, whether you own an asset or you lease an asset, both businesses that owns an asset and lease an asset has one common: they have control over those assets. They can use the asset in any way they want to generate economic benefit. The next question to a beginner in accounting is this: the asset we are talking about is classified. And let's look at the classification of assets. Classification of assets. Assets are classified into two. What are the two classifications? A, we have what we call non-current assets. This non-current asset is previously called fixed asset, but we no longer call it fixed asset again, in line with International Financial Reporting Standard. In line with this International Financial Reporting Standard that business has adopted in preparing financial statements, the fixed asset is now called non-current asset. What are non-current assets? Non-current assets are tangible assets. Are tangible assets that has long life span. They are resources acquired into the business that can last for years. Example of non-current assets. Example are building is an example of non-current asset. Furniture is an example of non-current asset. Fittings is an example of non-current asset. Machineries is an example of non-current asset. We also have a plant is an example of non-current asset. We have Motor van is an example of non-current asset. We have non-current asset that is not popular. We call it biological assets. When you look at it, what is biological asset? Biological asset is in line with International Accounting Standard 40. An example of biological asset that we want to tell you are cow. Cow are resources that has a long lifespan and they can be used to generate economic benefit. But the question is this: when we call it cow, is an asset. But when the cow is being slaughtered in order to take to market to sell, it's no more an asset again. It becomes what we call agricultural product. Just like Iroko tree. Iroko tree can also be called biological asset. But once this Iroko tree is cut down and it is being used for another purpose, we call it agricultural what? Product. If you want to read more on biological asset, you go to International Accounting Standard 40, which is IAS. You can type it on Google to tell you more about IAS 40. IAS 40 is talking about accounting for agriculture. And under accounting for agriculture, you come across what we call biological asset. For those of you that want to venture into mechanized farming, cow, Iroko tree, and other things in the farm are to be classified under non-current what? Asset. This is one of the classification of asset. The second classification of asset is known as current asset. What are current assets? Current assets are liquid assets. They are liquid assets that can be converted into cash within 12 months accounting period. 12-month accounting period. Now the difference is this: non-current asset and current asset. What differentiates them? Non-current assets are resources that can last for more than one accounting what? Period. 5 years, 10 years. But there are some assets you need for day-to-day business operation that can be used to generate immediate economic what? Benefit. Those resources are known as current what? Asset. They are liquid asset. They cannot stay longer than 1 year and they can be used to generate economic what? Benefit. What are the examples of non-current asset? The example of non-current assets, we have inventory. Some of us, this is what we know before as closing stock. But in line with IFRS now, we don't call it closing stock again. We call it inventory. Also, we have receivable. Formerly, we do call this debtors. But in line with International Financial Reporting Standard, we don't call it debtors again. We now call it trade receivable, or we call it receivable. Another example of current asset is cash. And another example of current asset is the money kept in our bank. And another example is bill receivable. Another example is prepaid expenses. These are examples of current asset: inventory, receivable, cash, bank, bill receivable, and prepaid expenses. The next question is this: the addition of this non-current asset and current asset is what we know as total asset. The addition of resources that you have control over a longer period of accounting years, plus the resources you have control over within the 12-month accounting period. When you sum two of them together, you arrive at what we call total asset. This is first this terminologies under asset. Now, the top terminologies we are going to be looking at is called liability. The third one is called liability. And the next thing we want to ask is this: what is liability? Liability are past obligation, are past obligation that the fulfillment can lead to outflow of business resources. What do we mean by this? Liability are past obligation that organization needs to fulfill in the future. For instance, most businesses cannot trade only on their capital. They need to borrow. They need to finance the business with loan and overdraft or debenture. In that case, the money that is borrowed from an outsider to finance a business is known as liability. Meaning, as an accounting student at this level, once you borrow money, either through friend, through financial institution to operate your business, that money that is being borrowed should be categorized as liability. While the resources you have control over should be classified as asset. In that case, liability too also have classification. Want to look at classification of liability. As a beginner, liability is classified into two. A, we have what we call non-current liability. And what is non-current liability? There are obligation. There are obligation which the settlement allows more than one accounting year. More than one accounting period. What we mean is this: any money you borrowed, but you are allowed to pay back within 5 to 10 years, we know it as what? Non-current liability. Some textbook call it long-term liability, but the new IFRS 10 is non-current liability. An example of non-current liability is known as is debenture, or sometimes we call it loan notes. The second classification of liability is current liability. Current liability are obligation that is being settled within 12-month accounting period. Within 12-month accounting period. And what does this mean? Any money you borrowed and you have to pay back within 12-month accounting period is known as current liability. But any amount borrowed, but to be paid back in 5 years, in 4 years, in 10 years is known as non-current liability. While the obligation that must be settled within 12 months is known as current liability. Example of current liability are trade payable. Trade payable. This is what is formerly called creditors, but we don't call them creditors again. We call them trade payable. Who are the creditors? Those that supply goods to the company on credit. They are our creditors, but now we call them trade payable. We also have what we call bank overdraft. Bank overdraft. Bank overdraft is when the financial institution allow a business entity to withdraw more than what the person has in his saving or current account or in the business account. For instance, you have 20,000 in your business account and you need 100,000 to do business. It means you have to apply for overdraft, like you are borrowing, that the bank should allow you to withdraw more than the 20,000 available in your account balance. Once the bank allow you to withdraw 100,000, it means you have borrowed 80,000 from the bank, and the 80,000 that is being allowed to withdraw is known as bank overdraft. We also have short-term loan, but we can call it loan. It's also an example. And we also have accrued expenses as example of current liability. Having known three terminologies, we can now go into accounting equation. Now, what are the three terminologies that we have looked at, which will be used to derive our accounting equation? The three terminologies we have looked at so far are: one, we have looked at the meaning of capital. Two, we have looked at the meaning of asset. And three, we have looked at the meaning of liability. We have said capital is the money introduced into the business by the owner. And we have said assets are resources that the business has control over in order to generate economic benefit. And we have said liability are obligation that has happened as a result of a past event, which the settlement can lead to outflow of business resources. Now, from these three terminologies, equations are derived. We can now say we want to derive our equation. We want to derive accounting equation. The first equation is saying capital equals to asset. What do they mean by this? If an owner introduces 1 million into a business, that 1 million will be seen as a capital. And if the 1 million was used to acquire a delivery van, a delivery van is an example of asset. In that case, we can say 1 million introduced into the business is as same as delivering van inside the business, meaning 1 million introduced capital equals to 1 million naira delivering van purchase asset. In that case, your 1 million naira capital is equivalent to your 1 million naira delivering van in the business. Equation 2. Equation 2 is when we say capital plus liability equals to asset. What do we mean by this? For example, you have introduced 1 million naira into the business to acquire a delivery van, and you don't have any money again, and you are producing pure water. You need money to stock table water and pure water, but there's no money again. You decide to go to your bank, and your bank borrow you 500,000. What do you use the 500,000 to do? You use it to stock finished goods. That's the pure water. That pure water you use the 500,000 to store is known as inventory. And inventory is one of the classification of assets, which means the 1 million naira that is being used to buy delivery van, that's non-current asset. And the 500,000 that was used to stock table and pure water is also current asset. Addition of delivery van 1 million plus inventory 500,000 will give us 1.5 million. In that case, the money you introduce 1 million plus the 500,000 loan you borrow from bank, 500,000. 500,000 plus 1 million will give you 1.5 year. 1 million delivery van plus inventory of 500,000 too will also give you 1.5. Meaning your capital plus your liability equals to your total asset that you have control over in the business. The third equation is now to go mathematically. What do you mean by mathematically? This is capital, if I'm correct. Capital equals to asset. This is plus liability. If we carry plus liability and to the other side, which is taking a like term, the plus automatically uh, change to what? Minus, and that become minus what? Liability. Let me give you an example. Formerly, you have 1.5 million as asset, which is the delivery van and the inventory. Inside this 1.5, you take a loan of 500,000. If this loan is being paid back out of your 1.5 million asset, what you are going to be left with is 1 million naira, which is the money you introduce into the business. Now, the fourth equation is telling us complete financial statement. If we said capital plus liability plus profit equals to our asset. And the last equation is capital minus liability minus loss also equals to asset. These are the 5 accounting equations we have. The first equation said capital equals to asset. The second equation is saying capital plus liability equals to asset. The third equation is saying capital equals to asset minus liability. The fourth equation is saying capital plus liability plus profit equals to asset. While the last equation is saying capital minus liability minus loss equals to asset. We are going to look at a short illustration, very short illustration to demonstrate whether these equations are correct or these equations are wrong. I'll be looking at a very simple and small illustration to prove whether any of these equations are correct. Let's look at this. Yasmi Enterprise provide the following transaction. For the month of January. (2023). On January 1st, started business by cash 500,000. January 5, bought goods on credit worth 300,000. January 15, January 15, bought January 15, bought furniture by cash 200,000. And January 30th, 31st, sold goods on credit to Ayo. So Ayo, 700,000. Required. Proof that capital plus liability, proof that capital plus liability plus profit equals to asset. This question said we should prove that capital plus liability plus profit must equals to what? Asset. How do we prove this? This is the proving. Yasmin Enterprise. We want to prove this transaction of Yasmin. And what we are going to do to prove, we'll say capital plus liability plus profit equals to what? Asset. We give it naira, 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 naira. Let's prove this. It requires explanation. Please pay attention to this explanation. On January 1st, we have started business by cash. Started here stand for capital. We will first identify the two accounts in each of the transactions and where they are being classified into. Started in accounting means capital, meaning the 500,000 there stand for capital. What did they start with? They start with cash. Cash is classification of current assets. In that case, in this January 1st, we don't have liability. In January 1st, we don't have what? Profit. But in January 1st, we have a 500,000 cash. In that case, the two items in January 1st is capital, which is started, and which we bring from the word started there means capital, and the cash, which is an asset. We are done with January 1st. We are just to identify two accounts. Started, capital, cash, asset. On 5th, bought goods on credit. When they say bought goods on credit, from who? From supplier. And when you are buying on credit, it means liability is involved. On January 5th of 300,000 is involved. Under profit, what do we call liability? We have a payable, which is supply on credit. At the same time, we have purchases of 300,000. Where do we get purchases? Anytime you see the word bought goods, it means purchases. And this transaction, there is no asset. Bought goods is purchases, is an item of profit or loss. Why? On credit there, stand for supplier. That's payable. We have identified two. The goods they bought on credit is loan, it's a liability. And the goods they also bought here is an item of profit or loss. On the 15th, January 15, we have bought furniture. This time they identify what they bought. They bought furniture. Furniture is an item of asset, meaning capital is zero. There's no liability. And this time, there's no profit. But there are two assets. There are tangible assets and current assets. Bought furniture, that's plus 200,000 plus 200,000 furniture minus 200,000 cash. That gives us 0. When you are buying more furniture, it's an addition to your business. When you are using your cash to buy, it's a subtraction of cash, meaning it's plus and minus to what? Asset. On 31st, sold goods on credit. Sold goods means sales. Sales is not capital, that's 0. Sales is not liability, that's 0. Sales belong to what? Profit or loss. And how much? 700,000. 700,000 sales equals to debtor. Debtor is an asset, and that's 700,000. That's receivable. Receivable is IO. The person they sold to on credit is known as debtor, and debtor is known as receivable. From this, let's see what our calculation will give us. This is 500,000 plus 0 plus 0 plus 0, and that gives us 500,000. This 300,000 plus 0 plus 0, that gives us 300,000 liability. Now this is profit. How do we know we are making profit? We purchase an item for 300,000. The item was sold for 700,000. If we minus the amount of sales from amount of purchases, we are going to arrive at 400,000. Let's go to the asset. We have 500,000 cash. The second asset was 0 plus 200,000 minus 200,000, that's 0. That's 500,000 plus 0, we still have a 0, plus 700,000, meaning 500,000 plus 700,000, that will give us 1.2 million. Let's see whether we are correct. Capital is 500,000 plus liability 300,000, that's 800,000, plus profit, which is 400,000, equals to what? Asset. In that case, let's see this way. Capital 500,000 plus liability, which is 300,000, plus profit 400,000, equals to what? Asset 1.2 million. Without opening ledger, without preparing a bulky financial statement, we are able to summarize the financial statement of Yasmin what? Enterprise, to get the amount of capital in that year, in that month, to get the amount of liability, and to get the amount of profit, and to know the total amount of asset. In summary, what we did is this. Started means capital, and cash means what? Asset. Yeah, but goods means purchases. Purchases is an item of profit or loss, and on credit means payable. Credit there means supplier supplying on credit. Payable, that is liability and profit. Meaning others will be 0 because the transaction did not consign them. But furniture is an asset, that's plus furniture. And by cash, we use cash. We give out cash to acquire furniture, that's minus cash. This all equals to 0. Here we say sold goods. Sold goods means sales. Sales is a profit, and minus on credit. On credit there means debtors. IO is a debtor, and IO belongs to categories of receivable. Thanks for listening to us. This is an accounting equation. In summary, it is a mathematical representation of financial statement, where we said 1, capital equals to asset. 2, capital plus liability equals to asset. 3, capital plus liability plus profit equals to asset. 4, capital plus liability minus loss equals to asset. And we can also say capital equals to asset minus liability. Thank you for listening to this interesting topic called accounting equation. We want to, as we have been doing, we give thanks to our listener, our audience, for viewing this particular our previous video. we urge you that anytime you are watching the video, remember to click on the link that put you on, remember to subscribe on that YouTube channel. Thank you for listening to our previous lecture and this lecture. God bless you. Thank you.